is what I was hoping to get out of the Great Adventures for chapters 8 and 9. This has to do with deferred revenue because they sold some gift cards and they will get the cash, but they will not earn the revenue until later. So here we're going to record the sale of gift cards in December, so I'm assuming it'll be on, the 19th. That part doesn't really matter, but when we get the cash in, obviously we're going to debit that, and then when we make the other side of the entry, if we didn't earn the revenue, we're going to put that into deferred revenue. And that is a liability to us, so that's a credit. So when they are redeemed in January, again, the date doesn't matter, but let's say it's on the 31st, then they're going to take some out of deferred revenue. And how much? Well, looks like customers redeemed $20,000. And then they're going to go ahead and earn the revenue. You could call it service revenue or, whatever. But that would be the general entry that you would want to make. So you would do the following in February, in March, and in April. And if you add all of that up, it'll add up to $90,000. So in May, even though the customers did not redeem $10,000 in gift cards because they expire, you're going to naturally be able to earn that revenue. So that's the entry that would go into May, is the remaining. Okay, let's move on to the next part. And the next part has to do with warranties. So they are going to start selling kayaks. So they sold $1.6 million of kayaks. They estimate their future warranty cost to be 2% of their sales, and actual warranty costs are $25,000. So here's what we're going to do is we're going to figure it out. So if I have, I'm just going to do a little side calculation over here and change that to a number. Okay, so there's my sales, and if I want that to be 2%, oops, I'm going to, if I want that to be 2%, I'm going to multiply that times 0.2. So that would be $32,000. So that's the entry, and I'm going to make that to warranty expense of $32,000. Okay, and that will be a warranty liability, which is a liability. So that would be the $32,000, and that's the other side of that entry. Now, when they have warranty costs of $25,000, they didn't really tell us, so we'll go ahead and just call that labor to fix it, right? We didn't really get specific on that, but here would be the warranty, the warranty liability, and that would be $25,000. Oops, not 25,000. All right, and then the other side would be, let's say it's wages and salaries or whatever to fix them. Okay, so the most important part is that you have to take that out of warranty liability. Then it said record the revision of that. In year 2, they had additional sales of $2.4 million and revises its estimate with years 2 to be 1.7. So let's look at this. All right, so we've got our I'm going to try to make a little T account for you. So here's my warranty liability account, right? And I'm going to make that bottom, merge and center that. So there's my T account. So that was my liability, which was this amount over here, right? And then we had $25,000 that we took out. So what's our balance at the end of the first year? It's $32,000 minus that 25, so it's $7,000. That's what I have in my warranty liability account. So then what they do is they say, well, you know what, we want to revise that warranty amount. So now they're going to sell $2.4 million in kayaks, which is great because they sold more, and now it's going to be 1.5. So we're going to take that and multiply it times 0.15 and come up with $36,000, and that's what we need as the ending balance in our liability account. So if we have $7,000 as an ending balance at the end of the first year, and we know we've got to get it up to $36,000, right, for the next following year, then what's the amount here? And that's the entry that I'd like over here. Okay, so warranty expense will be the 36,000 minus the 7,000, and you'll put that into the warranty liability account, and that's how you solve that one. Now this is a simple interest one, so I've made a box for you just so you could transfer the information down here. So the amount of the loan is 50,000, the interest rate is 6%, the number of years is 6 months, so that's like 0.5 years, and the number of, the number of years. So the important thing to know is on a notes payable, they are simple interest. So here's what I'm looking for. So the number of months in the year is obviously 12. So we're going to take the loan amount and we're going to multiply that times the annual interest rate. And remember, because that's annual, we now have to divide by 12. So the monthly payment is going to be $250. So the question asks us to record the purchase, right? So on 8/1/2020, then they take in the cash because they're borrowing the money, and the other side of the entry is the notes payable, which is a liability, 50,000 over here, and then it says record the entry on 12/31. What's going on at the end of the month? Well, there's a couple months that have passed where we need to record the interest. So on 12/31/20, then we're going to have some interest expense, and we're going to have some interest payable. So do we know how much that is? That's what we're going to figure out next. So since we know what the monthly amount is, and these are monthly payments in terms of, there's one clarification I'm going to make, those are the interest. That's the amount of the interest every single month. So then how much time has passed from August 1st? So there's August, September, October, November, December. That's 5 months. So we're going to take this and multiply it times 5. Okay, and that's how much interest payable we have. But we're not going to pay it because it says the principal and the interest are due at the end of the note. So when we go ahead and repay that, and when we're going to repay that in 6 months, which will be at the end of January or the 1st of February. I'll just put the 1st of February, either one's fine. All right, then what we're going to do is we're going to repay the note. Right, so we're going to take that out of our notes payable, but then we're also going to have some interest expense for the next year. And actually I made a mistake. This should be the next year, which would be 2021, since we took it out in 2020. So how much is our monthly interest? It's $250. So that's how much interest expense we have for 2021, and then we take the rest out of the interest payable when we recognized the interest for 2020, which was $1,250. That goes over here, and then the rest is actually made up of cash, which would be the total of all of these debits. Okay, and that's how we figure that out. And now we'll go on to the installment notes, which is what we covered last week. Okay, so here we're doing installment notes, which are different than simple interest note payables quite a bit. Okay, so what we're going to do is we're going to use the Excel function of the PMT. So on the loan amount, we're just going to copy that down from the data that I gave you up above. The annual interest rate is 6%. The loan terms are 10. And the interest rate per month, I'm going to have you do this for a reason, but you divide that by 12, and the loan duration in terms of months would be the 10 years multiplied times 12, right? So now we have everything in terms of months. So now we're going to figure out a monthly payment. This is a function, so we're going to come up to the f of x. We're going to look up to the PMT, and there's our PMT, and now we're basically going to enter, that's why I had that little example right over there. Now we're going to enter the function in terms of months, the number of periods in terms of months, the present value is how much we're taking out, and that will be our monthly payment. Now if you put a minus in between the equals and the PMT, then you'll come up with a positive amount, and that is the bingo number that we need right now. That is the monthly payments. Those will be the exact same payments every single month. Okay, that's like a car payment, a loan, mortgage payment, that kind of thing. So how do we enter the first part of this? That's when we took out the loan. So we took it out on 1/1/2020, and then we're going to get in the cash because obviously we're borrowing that $500,000. Oops, need another zero there. And then we're going to take that out into a loans payable. Okay, a liability, that's a credit. All right, and then it says record the first 3 rows of the amortization table. So on January 1st is when we took it out, so we will, it says the monthly payments are due at the end of the month, so fine. So okay, so hang on, I'm going to enter the carrying value over here, which is basically how much we borrowed. And then on 1/31/20, then our first monthly payment, those will always be the same, which is that amount right there. Okay, so the interest portion, I don't know what happened over here, but this should not be merged. There we go. The interest portion is simply the carrying value multiplied times the interest rate divided by 12. Okay, so that is and why did we divide by 12? Because it's every single month. So the decrease in the carrying value is simply what we paid for the monthly payment minus how much of that is being applied to the interest. So this is the decrease in the carrying value. I'm going to carry that out by a decimal. So then the new carrying value would be the old carrying value less what we just decreased it by. And then the next month will be the same thing. All right, so my monthly payment again always stays the same. My interest portion is now the new carrying value times the 0.06 divided by 12. And let's take that into a nicer looking formula. There we go. Okay, and then the decrease in the carrying value again is what my monthly payment is less what was applied towards the interest. Make sure I have enough decimals showing. Okay, and then my new carrying value will be my old carrying value less what I am decreasing that amount for. So this is how it goes. So I'll do one more. Here is 3/31/20, and again my monthly payment's always the same. My interest portion is the carrying value times that 0.06 divided by 12. I'll take that into a little nicer format there. And then the decrease in the carrying value is the monthly payment less the interest portion. Oops. Okay, and then the new carrying value will be the old carrying value minus what my reduction in principal is. And that is the first 3 rows of the amortization. Okay, so the next part is it says, well, please make a journal entry for that. So on the first one, which was on January 1st of 2020, then I'm going to have interest expense of this $2,500, and I'm going to have a note payable, and that's the amount that I am decreasing the note by, which is the decrease in that carrying value, and the rest is the cash, which, believe it or not, is the combination of this and this, otherwise known as the monthly payment. Okay, the second entry, which would be in February, would look something like this. So I'll have my interest expense just like I had before. If I could spell, that would be really helpful. Okay, but how much is my interest expense now? Now my interest portion is this much. Okay, my note payable goes down by the reduction in my carrying value, which is this amount right here, and my cash, which is my monthly payment, is the combination of this plus this, which is always my monthly payment. So that's how my monthly payment got split up. So it says, what are the total payments over the next 10 years? Oh my goodness. So I take my monthly payment and I multiply that times 10 years times 12 months, and that's how much I'm going to pay on that loan. So what did that loan ultimately cost me in terms of interest? Well, how much did I pay for that whole loan? And then how much was the loan actually for? It was for $500,000. So that's how much interest expense I actually paid, right? So that's how much I paid over the 10 years. Every single month I paid $551.03, and I only borrowed $500,000, so that means I paid in total interest $166,123. Oh my goodness sakes. The next one actually just blows this out so that you can actually see it. So there's my 551 over the next 10 years, right, for 12 months every single year. So that just added that up for you. Okay, I'm not as excited to see you do that, but that is the loan amortization, which is kind of fun, so that you can see that the thing I'd like you to pick up on is that the interest portion goes down every single month. It finally goes down to $27.11, and the amount that's applied to principal goes up. All right, that's because you're paying less interest on what you've actually borrowed, which is the carrying value. Okay, as for bonds, here we go on the bonds. So here, looks like I've already got some data in there. Let's take that out so I can walk you through this. So here my market interest rate is 7%, and the market is paying 7%. Okay, so the face amount of this bond, which we got from class, okay, and just for reference, I'm going to take you back to what we were talking about. So the face value was 100,000, right? I'm going to tell you how to do the interest payments and the market interest rate, and the number of periods was 20. So we have a 10-year bond. Twice a year it gets paid. So the face amount of this is going to be 100,000. All right. The interest payments, again, because the face value is the stated rate, we also call that a stated rate, is 7%, right? So that's going to be a percentage, 7%. All right, the face value is $100,000, and the interest payments are always going to be the same no matter what, which is going to be this divided by 2, because we're going to pay that semi-annually. So let's take that and make it into a currency. Okay, so the market interest rate divided by 2, so in this case for the first scenario is 7%, so we're going to take the 0.07 and divide that by 2, and I'm going to just stretch that out. The number of periods, it's a 10-year bond, and I realize I didn't put that on here, number of years, so I'll indicate that here, 10 years, but it's not a percentage, so I'm going to make that into a dollar. All right, so the number of periods would be the 10 years, and we're going to pay interest semi-annually, so that will be 2. All right, so that's that, kind of the whole setup of it. All right, so if we take this and to fill this out, if we're going to do this at par, what is the issue rate? So this information always stays the same. It's like this is the information about this bond. All right, so when we look at the issue price, if the stated rate is 7% and the market rate is 7%, then what we're going to do is, now this is a present value function, so we're going to come up with the present value function. The rate will be the semi-annual rate. Okay, so because the market rate is 7% and the stated rate is 7%, I can use this 3.5. The number of periods, always 20. The PMT will always be 3.5, and the future value means how much am I going to be paid back at the end of the bond, and it will be the bond's price, and that is how much we're going to issue it. That's how much we're going to charge our customers. Okay, so, and that's good because that is the face value. So when the market rate equals the stated rate, the issue price will be the same as the face value. All right, in other words, I don't have to give a discount, I don't have to give a premium. All right, so let's say the market rate is 10%. Okay, so the stated rate is still the 7%. The number of years is still the 10, right? The face value is still the 100. The interest payments is still the 10 multiplied times the interest rate divided by 2. That never changes. That is always the same. I can't stress that enough. Okay, but now what's the market rate? Well, the market rate says that it's 10%. So let's take that 10% and divide it by 2. So why do I divide it by 2? Because the interest payments are paid semi-annually. Okay, number of periods, again, that always stays the same at the 20. So the bond function itself never changes. But now let's look at the issue price. So if the market's paying 10% and I'm only paying 7%, is that a good deal for investors or a bad deal? It's not a great deal, let me tell you. So let's find out what the present value is going to be for there. So I'm going to click this. So what's the rate? The rate is now this. The number of periods is 20. The payments are still $350. And at the end, the investors are still going to get their $100,000 back. So what's the issue price of this scenario? And I'm going to put a minus sign between there. And the investors only have to pay $81,306.68. In return, for the next 20 periods, they're going to get $3,500 every 6 months, and they're still going to get their $100,000 back at the end of the 10 years. Okay, let's look at it when the market rate is 5%. So the stated rate, again, is still 7%. That doesn't ever change. That's what's written on the bond. Okay, the number of years is still that 10 years. The face amount is still that 100,000. And the interest payments, guess what? They're still that 100,000 times the interest rate divided by 2 because we pay that semi-annually. The market now is only paying 5%, so that's 0.05 divided by 2. Number of periods is still a 10-year bond. Interest is paid semi-annually. That's 20 periods that it's going to be paid. So now what's the interest? The issue price. So there's my PV function again. So my rate is the market rate. That's what we always put in that rate. Number of periods, the payment, and the future value. I still got my $100,000 back, and holy cow, look at that. That means, oops, this is the deal, is that the investors have to pay $115,589.16 for that. In return, they're going to get $3,500 every 6 months, and at the end of the 10 years, they're going to get that $100,000 back. Okay, so, and there's just more practice over here for you to do exactly the same thing here on the bond amortization and discounts. I'm not going to worry about those, but you can certainly work on these based on what you get over here. So once I worked this one out, then I could see that my issue price was here, so I've carried that over here, and then the cash payments were $42,000 every 6 months, which was what I had calculated here. So when I do this for the next 10 years, which is 20 periods. Try that one more time. I'm going to anchor that. Okay, let's see if this works. Okay, for the next year. All right, so the discount, now I'm going to do, the book does it slightly different. I'm going to just do simple amortization here. So if the bond is issued at 1.4 million and I only have to pay 1.2, then that's obviously at a premium, or excuse me, it's at a discount, right? I'm paying less than the bond is actually worth. So what is the amortization? Well, I'm going to take the $1.4 million and I'm going to subtract what I actually issued it for, and there is the amount of the discount that the investors are getting. Okay, so I'm going to take that amount and I'm going to divide, I'm going to put that in brackets just in case. Okay, I'm going to divide that by the 20 periods. Oops, okay, didn't like that. Let's try that again. And we're going to divide that by 20 periods, and that's how much of a discount is going to be amortized every single period. Okay, I made this a little bit simpler for you. So the issue price of the bond was 1.4, and then I subtracted the amount that we got from the investors, which was this. So I took H6, which was 1.4, subtracted what we got from the investors, and this was the amount of the discount that we had to issue the bonds for. So if I take that and divide that by the 20 periods, you can see I divided by the 20 periods, you come up with the fact that on a straight line basis, the discount amortization was 7474.28. So the interest expense is what I had to pay them in cash payments plus what the discount is that I had to offer them to issue these bonds in the first place. So then the carrying value simply increases every single period by the previous carrying value plus the discount that I amortize. So if you take this all the way down and you take this and you take it all the way down over the 20 periods, you can see that eventually the amount of the bond gets up to the 140,000. So I know that sounds complicated, but just sit back and think about this for a minute. So I got this much from my investors. They got a discount of almost $150,000. So on a per interest payment basis, that would be $74.74 approximately. So to get this 120, this $1.25 million up for me as the issuer, I have to then increase the amount of how much I've had to discount that over the 20 periods, and it eventually gets me up to the 140. So in essence, what I'm doing is I'm taking this $140,000 and I'm adding it to the interest expense that I've actually incurred. Okay, so I hope that helps. And then the premium would be the same amount, only in this case you would be subtracting instead of adding that premium amount every month. Okay, hope that helps.